Hope you're having a good day, everyone. Thanks for joining us for Real Estate Market Update. Currently, there's still a lot going on in the market, so sit back and enjoy as Sebastian and myself try and walk you through the latest going on. So, as you can see from the agenda, we do our best to provide a comprehensive update on anything that affects the real estate market, really, from supply and demand to mortgages to current political or upcoming political policies that may have some influence. And for your convenience, we have timestamps below. So if you want to just jump to a specific section, feel free. And let's just jump into it then first with some market news highlights for you. So this is, I guess, the big thing everyone's talking about, right? Prices across the Canada, what's been going on. So just from a national perspective, the average price change was 21, taking into account with some, decreases in the territories. Basically every province across Canada started double-digit increases last year, apart from Winnipeg and PEI. They may catch up now as they are behind. But even stranger, though, about the last year is the largest gains were not in the major urban centers where it has historically been, such as Toronto or Vancouver, but they were actually in the smaller cities, some cities a lot of you may have never heard of. So the question is now, as we move forward into 2022, will this continue? Will the record prices, again, 21% year over year annually, is a record in Canada. Like, it's never increased that high. And in terms of the G7 countries, we're one of the highest increases as well. So now the question moving forward is, will it continue? And like everything, it depends who you ask. You ask 5 people, you get 5 answers. So let's take a look at what some of the experts are saying. So I broke it up into bulls and the bears. So on the bull side are those on the left-hand side are people who think that, hey, this is going to keep going. And on the bear side is saying, hey, we need some sort of correction. So personally, you may be more of a bear or bull right now, but let's just see what some of the bulls are saying. So if we look over some of the bulls articles on the left, the basic sentiment from them is it's not a bubble, but it's based on fundamental demand and supply issues with a limited supply. And this is sort of the new norm. So that's sort of where the bills are going, where the bears, on the other hand, think, well, the last 2 years weren't really based on fundamentals, but it was more based on speculation, fueled by low interest rates, changing demands where people want to live, increase in savings in home equity that people could use to invest. So there was a bunch of things that came together in the last 2 years that led to this speculation, and that's sort of where the bears are. So as those things change, and we come out of the pandemic back to their pre-COVID in terms of interest rates and society, they feel there's going to be some sort of correction or slowing down. So the truth is it's usually somewhere in the middle. Now, I don't see homes plunging 20 to 50%, as some of the bears are saying, but I don't see it to continue increasing at 20%, as some of the bulls are saying. So the truth would be, let's say, somewhere in the middle, where a lot of the more moderate voices are saying, you know what, for the first half, expect things to sort of continue as they were, because things will generally stay, until the second half, where the changes, those net changes that can affect the market, start to take effect, such as interest rate and supply, et cetera. So some of the big factors or forces that can affect something once it's in motion are employment is big for housing. So there's going to be a big up or down move in employment, such as when Alberta, the oil sands open up, ton of movement out there, a ton of employment, good jobs, and housing demand. When it shuts down, slow down. Same if a Ford plant or auto company shuts down in Oshawa, have a huge impact on the city. So employment's one of the big ones. Next is interest rate changes, which Seb will talk more about. And those have a direct impact on housing as well. Canada migration, again, another big one. More people, more places to live or rent. It's pretty straightforward. The next one is sort of more tricky. It's about taxes or like mortgage rule qualification changes for investors and speculation taxes. So those do have an effect, and they probably have the strongest and harshest effect. And so that's why governments are pretty hesitant to use those. And a fifth one there is just increasing supply. So that can be done in various ways, and which we'll look at. So let's look a bit more at some of these external forces that people are using to try and change the market. So it's sort of meant into there's two main viewpoints. One is supply side issues. The bulls are saying, hey, supply side, you need to fix the supply, but as long as supply is low, it is what it is. So on the supply side, as the first article there is pointing out, finally in their mind at both the federal and provincial levels, there's been a lot of push by governments to increase supply. So a lot of this, especially if you're in Ontario, relates to, our Premier Ford had a housing task force, and a lot of what they're going to do is, remove various zoning bylaws, cutting red tape for housing permits, and, providing better establishments to just move things forward and reducing the amount that communities can protest. So a lot of that is definitely going to increase supply. So of course, if you don't have as many restrictions or as rules, and there's not the huge long complaints process to slow things down, you're definitely going to have a lot more supply building. Where you can build driveway houses, backyard houses. You can build different types of structures in areas that were zoned for something before. So that's definitely going to increase supply. It's also going to change the look of communities. So that's why community leaders are likely going to be more involved in sort of trying to maintain that. But again, it's a provincial stat date. And at the federal level, they're trying to do changes as well to increase supply by giving money for affordable housing and also helping to speed things up. So just below that on the supply side, though, is just, a recent study from BMO, just sort of rebooting supply side a bit, saying, hey, you know what? Over the last 2 years, there really was not an increase in people or immigration coming in. There weren't all these new people that were coming to Canada. And in fact, the supply over the last couple of years has been increasing the population. So it's actually been increasing since about 2000. I think that's, they said the last, decade or so, we've been increasing. So again, BMO is again saying, hey, it's more based on speculation, which has made things unaffordable. So on the right-hand side, we'll look at the affordability side. So again, this relates to the tools we talked about to slow things down. So pay attention when you see these happening if you're an investor or buying the area, because these definitely will have an effect on prices. So the first one again is interest rates. It's a big tool. Bank of Canada has a big control over the variable, and Seb will talk about variables and fixed and bonds in the bank, but they've been going up, and that's definitely, as it's mentioned, getting Canadians worried, not about ones who wanted to get in but haven't, but also the pre-existing ones that may have stretched themselves a bit and what effects that may have. The second articles there about Hamilton and Toronto. These are related to vacancy and speculation taxes. So currently, Vancouver is the only municipality in Canada with a tax on vacant homes, although Toronto and Ottawa are going to have one in place by the end of this year. And other municipalities like Niagara and Mississauga have explored the idea. I think Mississauga city staff just said thumbs down last week, but it's still up to city council to vote. So again, in the areas where there is a lot more speculation and investment, the local leaders are trying to clamp it down so locals can still afford to live there. People that work can live there. So again, those are tools coming in on the tax side. And then the last item there is related to increasing supply. So what the federal government doing is they're creating housing that's specifically affordable. So it doesn't go into the general market where anyone can buy or sell or speculate on it, but it's fixed for sort of lower income people at a fixed cost. And again, I see this more as a Band-Aid tool. I'm not a big fan of it because it will help a few people. And it's great for PR saying, yeah, we're helping all these people, but it just helps, it helps the government with PR, but it avoids confronting the real issues that the majority need to be able to afford a home. So that's just a quick update on some of those. And if we just take a look at the market now, so what's going on with market prices? So this is a few recent bidding wars that I've been involved with. And as you can see, there's quite a few offers. So it's still quite active, especially on the condo side. And again, at the bottom there, I just noted it's part of FOMO, or the fear of missing out, just that demand of people. In combination in January, there was a very low supply. And then as we saw, and so we'll get more into, in December and January, rates did start increasing on the fixed side, and the variables, it's going to go up eventually too. So all that fear and timing and supply just led a lot of people to rush in January. And, a 10% increase month over month. So again, we talked about 20% on average last year, but between December and January, it wasn't uncommon to see prices of places go up by 10%, which was just insane. So in February, it has calmed down and flattened a bit, possibly related to buyer fatigue, more properties on the market, fixed rates risen. Like, it's a bunch of possible reasons why, but January was just a crazy selling time. So again, will it continue? Won't it continue? Personally, my view is, like I said, the first half of the year will still be, an active seller's market, but it is going to start to calm down as the other things come in, such as supply and interest rates and the new rules. So if we take a look, these are the stats that come out from the Toronto Real Estate Board. And just a few key points at the bottom then. So January, it was the lowest number of listings in 2 decades. So again, about the slow supply, but even though listings were at their slowest, sales and were the second best in history for January, which is funny when you think of the lowest inventory in 20 years, the highest sales ever apart from last year's record year. And also the price increases were some of the highest we've ever seen in January. So yes, there was much less supply, but sales and prices were still going in overdrive, and actually they picked up. And the average selling price now year over year is up 28.6% in the GTA area, with an average home going for nearly $1.24 million, which is putting a lot of people out of that price range. So, and the last note, because of that increase month over month, Toronto is now the most expensive city in Canada, finally overtaking Vancouver after about 10 to 15 years. So it's not an honor everybody wants, but it's what we have. And if you look in the red circle there, the 416, again, for those who aren't familiar, that's Toronto proper, where the 905 is the surrounding Greater Toronto area. So as you can see, the Greater Toronto area, such as Mississauga, York Region, Durham region like Oshawa, Ajax, they've had slightly bigger increases in most of the categories year over year, but Toronto has been catching up month after month. So that gap is getting smaller, but it as I'll mention in the future, that actually makes Toronto look like somewhat of a better investment at this point. So as often, sometimes a picture is worth 1,000 words. I just wanted to show you this graphical representation of the last 35 years of what's been going on in, GTA real estate. So pretty much like the stock market, has its ups and downs, but the overall trend has been steadily increasing. So in the past year, homes increased 20 to 90% across the province. That's right, I said up to 90 in some places in 1 year alone when looking at the prices from last year and this. So this has led a lot of buyers who bought last year thinking, hey, this is a good deal, I'm moving now, to like, wow, this is an insane price increase. I think this might be some sort of bubble. So they're looking at selling now. So I haven't seen so many homes being listed right now that were purchased in the prior year in 15 years of doing real estate. The closest time I saw was back in 2016-17, the 2 years leading up before the foreign buyers tax and title mortgage rules. And as many fellows also felt then, the market was at a bit of a peak then. And if you can look at the two bubbles there, the smaller bubble there is 2016-17. The bigger bubble there is what happened 2020 and 2021. It's the recent past 2 years makes the prior jumps pale in comparison. And again, we'll see what happens moving forward. But just keep your eye out for any of those changes we talked about, because they will have an effect on the market. So where are the best places to buy now? So that's always a question for investors and sometimes people who have the option to live in different places. Hey, where should I buy? Like, where's a good value? And the short answer, in the greater Southwest, area here, there's not really much in the GTA that I would say, hey, it's a great value. But if you didn't want to live somewhere in the GTA now, if you ask me where would be the least overpriced and best to sort of maintain and hold its value, I'd say Toronto, actually. And that again relates to what we said earlier, that the discrepancy between the 905 and the surrounding smaller areas with Toronto has decreased over the past 18 to 24 months. And that's strictly because a lot of people moved from the city. You're selling your $800,000 2-bedroom condo in the city, and you're getting a 2,200 square foot house in a small town and thing in Ontario for that money, plus money left over for a sports car. So there was a lot of people moving from the city to smaller towns as they could work remotely, and that's been there, and just they didn't need to be stuck in a condo that all the amenities were closed, the city's closed. What's the value in being in the city right now? So that's made over the last 2 years. Those prices shot up like 40, 50, 60%, whereas Toronto only shot up 20%. So what's happening now is, that $800,000 house in the smaller town is now going for 1.4 million, whereas we saw the average price of a place in Toronto is now 1.2. So it's becoming more comparable now. So the value of moving to a small town for the value has been decreasing. So if you were one of those people who did move in the last 2 years and you love being in the small town, then stay there by all means and enjoy the life. But if you were considering moving back to Toronto, I think as part of the reopening trade now, this might be the best time to get back to Toronto before it fully reopens and prices keep going up, as the disparity gap now is as big as it's been in history. So, yeah, so the smaller towns, again, they've increased about 40 to 50. Toronto's only about 20. However, moving forward, as we've seen the last month or two, Toronto's now starting to outpace the smaller areas in the province. So if you are thinking of making that move, now is a great time. So this is sort of looking at, the Southwest Ontario. So investors have also just said, fine, Toronto is, the most reasonable priced. There's also some areas in St. Catharines and Hamilton, but what if I want like a good deal? Like, where else can I go outside of Ontario? Well, good question. So this was put together from the Parliamentary Budget Office, which is an independent Canadian body, named the PBO. So they put it together based on some IMF data for a publication called Better Dwelling. And they found that most Canadian urban centers, in their opinion, were overvalued. So that would be that on the right-hand side of the line. Where they found the four at the bottom were the place that was still sort of affordable and not overvalued, in fact, undervalued. So they found Edmonton to be the most undervalued, followed by Winnipeg, and then Calgary and Quebec up there. So two of those places are in Alberta. So the buyers in Ontario and BC who are looking for a deal, guess where they went? If you guessed Alberta, you're right. So I've been getting a bunch of these emails that, if you're an investor, you may have seen them as well, but there's been a lot of promotion of condos in Calgary and houses in Edmonton. As Edmonton was the most affordable place, you can actually a 1,700 detached home for $500,000. From anyone from Ontario or Vancouver, that sounds crazy. But that's what you can get in Edmonton right now. So again, while it's a 35% increase from a year ago for Edmonton, the overall costs still seem relatively cheap and discounted to someone from Ontario, BC. So, and same with Calgary's in Alberta. So Calgary's again were 350 a year ago, now they're 500. Again, seems expensive and a huge rise for Calgary people, but for Ontario, BC, it's like, hey, that's a bargain. So this is pretty much what happened the last 2 years in smaller places in Ontario, where people saw, hey, there's a lot of value in these smaller towns, and they went up to bought it up. So now the same Ontario and BC buyers have moved over to Alberta. And again, so when will this stop? Will it stop? Well, that's to be seen. But let's pass it on to Seth for some thoughts on how interest rate changes coming up may affect this, this gold rush in housing.
Well, thanks, Jeff. I guess I'm going to start packing my bags and move to Edmonton. So let's start looking at the mortgage, the fixed rates that follow the Canada government bonds. That's been steadily increasing for the past year by a jarring 400%, as they were at the lowest at 0.46% last year, and we're now just above 1.8%. So the bond market has definitely recovered pre-pandemic levels, and it's now well above that. Interestingly enough, the general media doesn't make much mention of it, even though it's been a huge increase in fixed interest rates in the past year. On the flip side, the Bank of Canada kept its overnight rate, the one that affects the variable rate, at 0.25%. So it's been now like that for 2 years, and it's created a one-of-a-kind gap between fixed and variable rates that keeps widening. Right now, has never been seen before. The fixed rate could be as high as 3 times the variable rate. There could be as low as 1% for some insured mortgages, and close to 3% for their fixed rate equivalent. So that's quite a big gap here. So what's coming next? Well, let's look first at 2 telling indicators. The first one I'd like to look at is the net migration or population growth indicator. And there's been a recent 2021 census result that just came out. And it shows that Canada is the country with the fastest population growth in the G7. We've had 5.2% population growth in the past 5 years, so which is approximately 1.8 million more people were calling Canada home in 2021 compared to 5 years before. And 4 out of 5 of those being new immigrants, and a majority of them coming to the GTA. So Canada's net migration rate is very, very high. And if you look globally, it's the 8th highest in the world. And it's unique because it's mostly economic immigrants with good education. They usually were owning a home in their previous country. And it's not the case in other high-ranking countries, for which the net population usually is due to larger birth rate and also refugees intake. So it's not a surprise that Canada has the most significant housing shortage in the G7. And that began in the late 2015 when the federal government decided they would start targeting the entry of much larger number of economic immigrants. As we are, quite an underpopulated, relatively underpopulated country compared to others, and we do celebrate a growing population. It helps our workforce, it increases our GDP, so lots of positives about that. As Jeff mentioned, though, that's not the reason for the recent huge price increase, because in the past few years with COVID, there's been pretty much no immigration. So it's not really the reason. It is a long-term reason because, as Jeff mentioned, we will be having in the next few years more and more immigrants, and there's a shortage in housing. But right now, I wouldn't say the GTA is having a bubble because in the next 3 years at least, we're still going to see a large influx of new immigrants in the city. And whenever there's net positive immigration, and when the housing development doesn't go fast enough, but no bubbles can happen. So, government can blame foreign buyers, investors for housing shortage, but really it's inadequate planning and antiquated processes and policies that are really at fault here, especially when immigration is done as a federal level and all the levers to increase faster housing and development are done both at the municipal and the provincial level. So there's quite a mismatch there. The second indicator that I wanted to look at here today is really our inflation. This is a graph here of year-over-year change of the inflation that dictates the Bank of Canada adjustment for their overnight rate. So they like to keep it between 1% and 3%. The target is always 2%, but the 1% to 3% band is where they like to keep it. We've reached a 31-year high right now at 5.1% for year-over-year increase. So it's been definitely above that 3% target for about 10 consecutive months now. And most of us are aware of those issues and we feel it in our regular life. Grocery bills continue to rise quickly. The price of food purchased at stores is about 6.5% higher than last year, and that hasn't happened anything since 2009. Shelter costs have risen as well, 6.2% year over year, and that hasn't happened since the 1990s. And last but not least, all of us who own motorized vehicle has seen gasoline prices skyrocket, and they are like 33% higher than they were last year. So that's alarming, and the Bank of Canada definitely wants to act on that. But Canada is not the only country grappling with that high inflation. The supply chain imbalances caused by the pandemic, also coupled with record amounts of stimulus spending. And that created a combined push everywhere. And you can see here on the graph as well, the US inflation rate, it's even higher than us, it's 7.5%. And it's been the highest they've had in 40 years. So with all that in mind, I predict, like many others, that the next announcement on March 2nd at 10 a.m., by the way, the Bank of Canada is going to increase their overnight rate. And I would say they're going to be increasing by either 0.25% or 0.5%. The US is predicting they're doing 0.5% on theirs, but definitely there's going to be an increase. And while this increase will have no effect on the affordability, and that's the key point here, because everybody who gets qualified for a mortgage these days gets qualified based on a stress test, which is at 5.25%. So the fact that interest rate, the variable rate, will increase from where they are now to 0.5% will not change the affordability that people can have. However, I do believe that, part thanks to the media, that there's going to be a psychological cooling effect for all the new investors that have been real estate investors in the past few years. And by that, I mean homeowners that have seen their equity skyrocket and are trying to use it to put a down payment to buy an investment property. So these individuals, I predict, will mostly disappear from the buying scene because, one, the media is scaring everybody that the interest rates are going to go up, at least the variable ones. The fixed one, as we've seen, they've already been up 400%, so that's not going to make a big difference. But the main reason is those down payments that people are using from lines of credits, those follow directly the prime rate. So if that increases, the cost of those down payments for people will also increase. So I think these will definitely have an impact. On top of that, the typical spring market sees a lot more listings coming on the market compared to what we've had this winter. So, with those two, I do believe the market will cool a bit. And, by cooling a bit, what I mean is like there's not going to be as many multiple offers. So it's going to be a little bit more balanced. Still, I do believe it's still going to be a seller's market, but a lot more balanced, so a lot easier for buyer to buy something. So as a summary here, on the fixed side, everything has been going up with the bond prices 400% higher. That's a huge amount. The variable rates will start. My prediction is that they will start going up on March 2nd at 10 a.m. and likely by a quarter or 0.5%. And then the Bank of Canada will evaluate later on, is that enough to decrease inflation, or do they need to keep raising the rates a little bit more? So March should definitely be an exciting month. Will the rate increase and the media frenzy that follows be enough to cool down that market with reducing multiple offers? I would say it will, but let's see what happens. And then lastly, with our immigration having restarted at the tail end of COVID pandemic, I do predict that in GTA at least, especially Toronto, with a healthy net migration, prices will continue going up, but at a much smaller pace than this past year. So Jeff, back to you.
Thank you, Seb. Sometimes Seb and I differ on our viewpoints, but on this month, we're pretty consistent. So like Seb, I agree. The seller's market's going to continue for the foreseeable future until about the second half, where a lot of the changes come into effect, such as, more significant rate hike increases, possible speculation vacancy, tax changes, and the increased supply, both from just buyers and from the government policies. So that's why, but none of those are going to be like immediate, but I do see them sort of building up over the months. So the second half will be softer, less bidding wars, but not a drop per se, just, no longer spiking upwards, just sort of plateauing out. And I also agree that the continued reopening of the GTA, both for work, offices, for entertainment, social, sports events, restaurants, nightclubs, if you're still young and do that, and as well as immigration. So those are all factors leading, the Toronto, Mississauga area and the condo market in particular to basically, I see leading the way for growth in 2020 and price growth, because they're just the most affordable right now and just easy access people want to come into the city. March will also be a very important month though. So again, we're predicting how we think the year is going to go. March is generally a telling month for the tone and direction for the rest of the year. So stay tuned. Again, as these different policies and rates and everything come into play, March will be a very telling month. And then I pretty much see how March goes. That will be the motion, I guess, for the remainder of the year. So as always, thank you guys very much. Hope this is valuable. Please do click the like and subscribe and post a question or just email us if anything to ask. And have a great day and all the best in your 2022 investing in real estate.